the amount is supposed to be received in India in future. So that is also taxable. That means if the amount receivable is 5,000, so 5,000. Income accrues or arises outside India from business, profession, controlled or set up in India. Dividend from Indian company, yes, 1 lakh. Next, dividend from foreign company received in India, yes, this is also taxable. 1,50,000. Hello everyone, I am Arun Kumar, lecturer in Department of Commerce and Management, Vidhyaashram First Grade College, the Temple of Excellence, MYSURU. Dear students, welcome to this new session, that is session 2 on unit number 1, that is Introduction to Income Tax. So in the earlier session, we learned about what is income tax and the different terminologies which comes under income tax and the exemptions under section 10 and also the format. So in this particular session, once again we will be revising about the format for computation of scope of total income or the tax incidence. So in residential status, mainly we have 3 categories, right? So which are those 3 categories? Those 3 categories are, so ordinary resident, not ordinary resident and non-resident. So what we are supposed to do in this particular problem in computing total income, so we are supposed to compute the total income based upon the residential status of an individual, whether he is a resident, whether it is taxable for him or not, whether he is a non-resident, whether it is taxable for him or not. So for that purpose, we are supposed to know that income is taxable or not. First, we have to put 4 columns. So particulars, ordinary resident, not ordinary resident and non-resident. So in case income received in India, okay, in case if the income received in India, so what is the treatment? Taxable. For example, interest earned from Bank of Baroda, interest earned from Bank of Baroda. So it is Indian income, the income is received in India. So what will be the treatment? It is taxable under all 3 residential heads. In case if it is 5,000, so 5,000 here, 5,000 here, 5,000 here. Simple. Next, income deemed to be received in India. Okay, yet the income is not received, but deemed to be received in India. That means the amount is supposed to be received in India in future. So that is also taxable. That means if the amount receivable is 5,000, so 5,000. Okay. Next, income accrues or arises in India. Yes, if any income accrues or arised, okay, income accrues or arises in India, it is also taxable under all the 3 residential heads. Income deemed to accrues or arises in India. Yes, whether it is accrued or arised or deemed to accrues or arised, it is also taxable. So moving further, income accrues or arises outside India. Yes, that income is not received in India or not accrued in India or not deemed to received in India, but income arised outside India. That means foreign income, okay, like income from USA, that belongs to foreign income. So at that point of time, it is taxable, not taxable. That means if 5,000 rupees is receivable as a foreign income, then 5,000 should be taken in the first column, and for not order resident or non-resident, it is nil. That is not taxable. Next, income accrues or arises outside India from business, profession, controlled or set up in India. Yes, the business is outside India, but it is controlled from India. Okay, the business is in foreign country. Okay, the business is in foreign country, but it is controlled from India. For example, Infosys. So Infosys have branch in USA, but that USA branch is controlled from Bangalore head office. So at that point of time, it is taxable, not taxable. If the income is 5,000, so 5,000 here, 5,000 here, nil. Okay, so just you have to look into that whether the income belongs to India or not. If the income belongs to India, taxable. If the income not belongs to India, if it is a foreign income, yes, if it is foreign income by not controlled by India, taxable, not taxable. Controlled by India, taxable, not taxable. Very easiest one, just you have to know about the income, that's it. So we will solve the first problem based upon the scope of total income. So from the following details, calculate the total income of Mr. Raja if he is a ordinary resident, not ordinary resident and non-resident. So point number 1, dividend from Indian company. Dividend from Indian company. That means the income belongs to India, right? The income belongs to India. So what is the treatment? Yes, taxable, taxable, taxable. Simple. So earlier dividend received was exempt, but now it is taxable, it is not exempt. So second point, dividend from India, Indian company 10,000 is taxable, taxable, taxable. Next, dividend from foreign company rupees 1,50,000 received in India. Dividend from foreign company received in India. Okay, dividend from foreign company of rupees 1,50,000 received in India. So here you have the word received in India. So what the statement says, any income accrues, arise or received in India, so it is taxable, taxable, taxable. Simple. Income from business in Kenya but controlled from India. Yes, business in Kenya, foreign income, but controlled from whom? Controlled from India. So what is the treatment? Taxable, not taxable, not taxable. Next one, income accrued in Switzerland rupees 2,50,000, 2/5 received in India. Yes, in 2,50,000, 2/5 is taxable, taxable, taxable. Remaining amount is only taxable in the first column. For the second column and third column it is nil. So 2/5 received in India, that means 1 lakh rupees is taxable, taxable, taxable. Remaining 1,50,000 only taxable in first column, remaining 2 columns it is nil, nil. Income from business in Indonesia but controlled from Bangladesh. Okay, Indonesia but controlled from Bangladesh. So Bangladesh, it is not in India, it is belongs to other foreign country. So it is only taxable in first column and then not taxable, not taxable. If the foreign business controlled by India, taxable, taxable, not taxable. Not controlled by India, taxable, not taxable, not taxable. Very simple. So the first point, dividend from Indian company, yes, 1 lakh, 1 lakh, 1 lakh. Next, dividend from foreign company received in India, yes, this is also taxable, 1,50,000, 1,50,000, 1,50,000. Income from business in Kenya controlled from India, taxable, taxable, 2 lakh and 2 lakh. Next, income from, that is income accrued in Switzerland, 2/5 received in India. So what is the 2/5 amount in 2,50,000? That is 1 lakh. So 1 lakh, 1 lakh, 1 lakh, that is taxable, taxable, taxable. Remaining 1,50,000, that is 3/5, 1,50,000. It is taxable only in the first case. In the second and third case, it is nil. Next, income from business in Indonesia but controlled from Bangladesh. Yes, it is not controlled from India, it is controlled from other countries. So it is only taxable in the first case, second case and third case is nil. So this is how you are supposed to compute the problem. So moving to the next problem, second problem, Mr. Sunil earns the following income during the previous year, 2021-22. So interest from an Indian company received in Germany. So wherever the interest is received, but where the income generated, from where he is receiving the interest? India. So income belongs to India only. So what is the treatment? Taxable, taxable, taxable. Easy. Pension from former employer in India received in UK. Okay. So where income is generating? In India. So wherever the income is received, he is receiving in UK, but the income is generated in India. So what is the treatment again? Taxable, taxable, taxable. Next, income from companies in USA and received in India. Yes, again, received in India. The word received, you should always have to remember. So if it is received in India, taxable, taxable, taxable. Income from agriculture in USA but received in India, again, received. The word received you have to remember. So what is the treatment again? Taxable, taxable, taxable. Next, income from employment in Japan received there. Income from employment in Japan received there. It is not received in India. It is received in Japan only. So what is the treatment? Taxable, not taxable, not taxable. Next, past untaxed profit brought to India. So any past untaxed profit is received in India for the present year, it is supposed to be considered as not taxable. That means you are not supposed to show that amount in any of three columns. Okay, so this is not taxable in all three columns. Just you are going to put nil because it is a earlier year income. It is not present previous year income. So we are computing only the previous year income, not the earlier to previous year. So compute gross total income of Mr. Sunil for the assessment year 2022-23 if he is a resident, not ordinary resident or non-resident. So now very simple. Particulars: ordinary resident, not ordinary resident and non-resident. Interest from an Indian company received in Germany, as I said, taxable, taxable, taxable. That is 1 lakh, 1 lakh, 1 lakh. Next, pension from former employer in India received in UK. Yes. So the income is generating in India. It is taxable, taxable, taxable. 2 lakh, 2 lakh, 2 lakh. Next, income from companies in USA and received in India. Again, taxable, taxable, taxable. 1 lakh, 1 lakh, 1 lakh. Next, income received from agriculture in USA and received in India. Taxable, taxable, taxable. Income from employment in Japan received there. So the amount is received in Japan only, not in India. So taxable, not taxable and not taxable. Past untaxed income. So as I said, the past untaxed income should not be taxed in the present year. So it is nil, nil, nil. And you are going to total the outer column at the last. So 4 lakh 30, 4 lakh 10 and 4 lakh 10. Next, third problem. From the following information of Mr. Gautam, compute his income if he is an ordinary resident, not ordinary resident or non-resident of India. Point number 1, interest on Singapore development bond. Interest on Singapore development bond, 1,50,000, 1/3 received in India. That means what? 1/3 is taxable, taxable, taxable. That means 50,000 is taxable, taxable, taxable. Remaining 1 lakh, that is 2/3, is only taxable in first column. Income from agriculture in Sri Lanka. So taxable, not taxable, not taxable. Income from property in Mexico received there. Yes, income from property in Mexico received there. The amount received in Mexico only. So treatment: taxable, not taxable, not taxable. Income from business in Kuwait controlled from Mumbai, rupees 85,000. So business is in outside the country, that is in foreign country, but controlled from India. So what is the treatment? Treatment is taxable, taxable, not taxable. Next, dividend from Indian company received in Nepal. Dividend from Indian company, that means Indian income. The income belongs to India. So what is the treatment? Taxable, taxable, taxable. Simple. Next, profit from business in Chennai. The business is controlled from Singapore. So where the business is situated? Business is situated in Chennai. That means in India. So the income belongs to India. So what is the treatment? Taxable, taxable, taxable. If the foreign business is controlled from India, it is taxable, taxable, not taxable. If the business is India only, then whoever controls it, it is taxable in all the three cases. Solution. So what is the solution? Particulars: ordinary resident, not ordinary resident and non-resident. So interest on Singapore development bond. So 1/3, it is rupees 50,000, 50,000, 50,000 and the remaining amount 1 lakh. Next, income from agriculture in Sri Lanka. So Sri Lanka agriculture income, what is the treatment? If it is foreign income, it is taxable, not taxable, not taxable. So next point, income from property in Mexico received there. So income from property in Mexico received there is rupees 2,22,000, taxable, not taxable, not taxable. Next, income from business in Kuwait controlled from Mumbai. So 85,000, 85,000, nil. Dividend from Indian company received in Nepal. So 44, 44, 44. That is taxable, taxable, taxable because it's a Indian income. Profit from business in Chennai. The business is controlled from Singapore. Taxable, taxable, taxable. Again, it is a Indian income. That is why it is taxable, taxable, taxable. Next problem, pension received in India for service rendered in England, but the income is received in India. Service rendered, the particular service is rendered by a person in England, but the amount received in India. So any income received in India, it is taxable, taxable, taxable. Agriculture income in India, okay, it is exempt in all the three cases, because to entertain the farmers, what the government decided? The government decided to exempt the agriculture income. So agriculture income, it's always exempted under section 10, and in all the three columns the amount comes to nil, that is exempt. Next, income from business in Chennai received in England. So business in Chennai, Indian income, treatment is taxable, taxable, taxable. Interest on US bonds, okay, taxable, not taxable, not taxable. Past untaxed income brought to India, so no treatment for this, nil, nil, nil in three columns. Next, profit from business in UK controlled from India, so taxable, not taxable, not taxable. Dividend received from domestic company, yes, taxable, taxable, taxable. Domestic company is nothing but Indian company. Same solution, particulars, ordinary resident, not ordinary resident, and non-resident. First point, pension received in India, so 90,000, 90,000, 90,000. Agriculture income, yes, it is exempt in all the three cases, because to encourage the farmers, it is exempted. Income from business in Chennai, yes, 60,000, 60,000, 60,000, because income belongs to India. Next, interest on US bonds, yes, taxable, not taxable, not taxable, because foreign income. Past untaxed income brought to India, yes, it is nil, because we are computing the income of previous year, not earlier to previous year. Profit from business in UK controlled from India, yes, 50,000, 50,000, nil, because foreign income and it is controlled from India. So total the columns, all the three columns at the last, you will get the total, that is called total income. So this is how we are supposed to solve the problem. The first thing you are supposed to keep in mind that whether the income belongs to India or not. If the income belongs to India, if the income belongs to India, okay, income belongs to India. So what is the treatment? It is taxable, taxable, and taxable. Okay, if the income belongs to India, it is taxable, taxable, taxable. If the income not belongs to India, if it is a foreign income, okay, then you have to look into that whether the business, foreign business, is controlled from India or not. If it is controlled from India, it is taxable, taxable, not taxable. If it is not controlled from India, taxable, not taxable, not taxable. Very simple. Just you have to look into the income and you have to decide whether it is a foreign income or Indian income. If it is an Indian income, taxable, taxable, taxable. Foreign income which is not controlled by India, taxable, not taxable, not taxable. So this is how you are supposed to determine whether it is taxable or not with respect to computation of total income. So with this, I am going to wind up this session. I will meet you in the upcoming session. Until then, thank you all.